Coming up in this show, I'm going to bring you my opening comments on the markets. Arby has a sample of future speak for you looking at the analysis of corn. I'm going to bring you something new, a hot minute, a look at gold, and then we're going to get into the stock market. Matt has some great analysis for you on the 2-hour chart. I'm going to show you the S&P 500 chart for the daily, and of course the question is, have we reached that top yet that we were looking for in January? Well, I'll show you just in a few minutes.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the Ask the Market Week. It's a look back at what happened in the financial markets in the past week. And a look forward at what might happen in coming weeks. And hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market pulled back sharply in this holiday shortened week as the realities of a very weak economic backdrop with very weak economic data scared investors who had poured money into the stock market the first 2 weeks of the year. To open the week, buyers briefly tried the upside, but quickly retreated on Tuesday as the news hit the wires that regulators are threatening to break up the, quote, too big to manage banks. Banks, well, they already have trouble, and their earnings certainly mixed at best. And historically, the yield curve is, well, at a record, and that is really bad for bank earnings. And of course, we're in a very slow M&A period right now, and all that is headwinds for the banks. You wouldn't know that really looking at the good, strong upward movement that we saw in the banks and bank indexes after the October low, but now we think that group's got downside risk. Wednesday was a ton of economic data coming out and mostly pointed to a recession. Industrial production down 0.7% for the month. That's the second month in a row and really points to a contraction. Retail sales down 1.1% in December, and that was bad and worse than what was expected. The New York Fed Manufacturing Index comes out at minus 32.9. That's versus only an expectation of a decline of 8.6, and that is strong look at a pullback in manufacturing and, of course, recession. As investors saw all of that, they sold the market hard. S&P 500 finished down 62 points, the Dow down 613, as worries on earnings really are hitting the market. Interest rates, they fell sharply. And clearly, we're getting a little bit of a change here in the paradigm as money seems to be moving from the stock market into the bond market. 10-year yields fall down below 4% and definitely, below 3.4%, and that was below the range that we were looking for. Thursday, stocks down again. More earnings worries. And of course, the debt limit was hit, and that's all over the news. And I could really get into a lot of trouble here with a political rant. I'm going to avoid that right now because then I lose a good number of our members. So I'm going to stay away from that. But I just want to say that if the last time they had to raise the debt limit, they would have learned from that and they wouldn't have spent all that money, deficit spending, then we wouldn't have this problem right now. Well, think about that. Friday, stocks, well, they were mixed. And here we are at midday right now, and maybe improving some as the Dow was down earlier in the day, but now here it's moving slightly to the plus side, and the S&P 500 is now markedly higher, as I can see it now up 27 points here at the midday period. What's interesting is that the techs were led to the upside on Netflix, which overall, the earnings really sucked, if you ask me. But they had great sub numbers, as they're doing a decent job with coming out with new content, and that had subscriber growth stronger than had been expected. However, still, the whole FANG stock category, those what were the growth stock, well, that growth is now gone. And you can see that reflected in the fact that Alphabet came out today and they said, well, they're going to cut 12,000 jobs. And that is, in line with what we're seeing, the same thing going on in Amazon, Microsoft, Meta, all of them cutting significant number of jobs. And at some point, we're going to start to see that in the unemployment numbers. The Dow, which was weaker early on, was really because of the healthcare category. And that category is weakening, I would say. It had a huge upside move if you look at the XLV off of the October lows, but now momentum is starting to weaken. And I can see that the Dow, which was the strongest of the indexes now, is giving some of that relative strength up. And we potentially could see the healthcare as leaders on the downside when the next decline comes. The stock market overall followed our forecasts remarkably well, moving down into December as expected and then getting this rally into January. But now economic data is conveniently showing a lot of weakness, just at the time that we expect a peak to be coming in this stock market bounce. There is a ton of earnings pressure, and I think that earnings pressure is not only showing up in this earnings period, but I think the first quarter earnings in April are going to be really bad as they start to really get hit by this weak economic data and a recession, though it may be shallow, really taking hold. That is setting up that there may be selling in advance of those April reports on earnings, and that comes into our period of risk, which is in February and March. Despite this Fed tightening, interest rates had moved down very significantly, and that is creating that very steep yield curve. On the 10-year, though, it did move down a full percentage point, which is wild. 4.3% at the peak, down to about 3.3% at this recent low. And that's based on these recessionary expectations. And if there are recessionary expectations, it's going to hit those earnings reports. But we're back right now in the paradigm that bad data is bad for stocks. And it's good for bonds, but I don't think that's going to last long. We're looking for a peak in the bond market. And I think as the market weakens, which we expect, that we're going to see both bonds and stocks moving down into that expected low, which we think will come sometime in March. Bonds right now, I think they're getting ready to peak. Patterns are suggesting another upside try for a few days, and we're seeing that come into the market right now, as the peak that they made just recently is likely to get tested. And I'll show you that a bit later, and why I think that will be another selling opportunity. Sometime in the next 1 to 2 months, investors will feel hooked again, and they will be selling and probably capitulating, and that should make the low for 2023. Stocks for the day here at midday, indexes down for the week between about 1% and 3%. The Dow is the weakest based on the healthcare stocks turning down, and we think that relative strength is shifting. Bond market up about 0.75 of a point. 10-year yields move down 5 basis points, now at about 3.46. We think they're going to get up to about 3.7 soon. So a bond market sell-off is pending. Gold, which I'm going to show you in this hot minute coming up, is up about $6 on the week. Silver, very choppy right now, loses about 40 cents, and definitely weaker than gold. And we think it's going to have a decline here over these next several weeks and get down under 23, maybe as low as 22. And that is, we think, going to be a very high probability long entry opportunity. Dollar unchanged on the week. Euro and yen are peaking based on our work. That means the dollar is bottoming. Oil market flat, and we think it's about to take a downside leg. We think there's risk in oil into February. Don't forget, you can get all of our analysis on all of the commodities that we follow, 24 of them, including the stock market indexes. In Future Speak on Wednesday, Arvi does a spectacular job bringing that analysis and teaches throughout. If you want to learn our style of analysis, that is cycle analysis. I want to remind you, you can go to askSlim.com, look around, get an idea of what we offer. If you're new, we have a great level 2 special that I'm going to be showing you. It's a good way to get acquainted with our work. On YouTube, subscribe to our channel, click the notification bell, and like this video. Give us a thumbs up. On Twitter, follow us at askSlim. And any questions you have about what we show here, memberships, content, you can write to Matt at askSlim.com. All right, this is a preview of Future Speak, and Arvi is going to bring you a sample video of the 24 different futures contracts that we follow, including the indexes. This is level 2 or higher content. He's going to give you basically a cycle analysis lesson on corn right now, which is starting to look positive. Show him, Arvi.
If we jump over to the grain market now, let's look at force as ZC. And I have slightly modified this, shifting this just a bit left as it looks like a low has now formed. If we zoom in a bit further, what we see here is that we had both of these cycles that were due to form a low. This is what we would call a nesting period. This is where there is a period of risk. And you can see that's what this sell-off was right there. That's this sell-off, and then now we have turned up, indicating that we are likely now in a rising phase on both of these cycles, which is the dominant blue in the solid line color and the dotted blue here as well. That implies that we can still look for overall higher, and reasonable to look back at these old highs on the weekly, which is showing up around 706. If we jump over to the daily, I have shifted this slightly left, so let's focus on this blue cycle right there. That's this rally here. So this now needs to form a higher low, hold this zone from 673 to 663, and then turn right back up to the upside. We have already moved through this old high at 685, so that is positive. If it does form a flag, we will look for a long side trade idea for a move back into this zone from 687 to around 698 here in corn. So an interesting pattern, certainly, as we are looking at it.
Great work on that, as always. Really glad to see your incredible teaching ability and one of the real experts in the world on cycle analysis. This is new. All right, introducing this new segment, the Hot Minute. We're going to take a quick look at the gold market. This is the cycle analysis in gold, and you can see in here, there was an important low due right over here. You could see this big dominant cycle coming down, meeting these other cycles. It's called nesting, and then the bottom forming in here and moving up. Momentum indicator turns up beautiful and tells us that this is going to be moving to the upside. This is a super bullish chart. Right now, we're looking for a little peak in here, maybe in the mid-1900s, and then a pullback to maybe about 1860 in March. This would be a fantastic buying opportunity, as we think it's going to all-time highs in the gold market in the spring and summer. Take a look at the daily chart, and you can see here what we have is what's called a swamped cycle. In other words, it rallied the whole way up and only has a little time to fall. Same thing that happened over here as it got into the buy zone. This is another buy zone around the 1860 number, and then likely moving up. This is where the March weeklies come in over here, and we think that decline in February and March is going to get it down to maybe that 1860 level right over here, and then be moving up again to all-time highs. Super buying opportunity that would come in March, and this is an extremely bullish situation for the gold market. I hope you enjoyed that hot minute, and see you again with one of these soon. All right, stock market analysis, S&P 500, short-term analysis. But first, you can get a ton of our content and analysis for just $29.50 for a whole month? Unbelievable. This is the level 2 special that we're showing you right now. We're not going to run this one very long. We have some requests that people are asking us for a 1 month special. So that's what we're doing right now. This is half price, and you'll get all of our trade planning tools, which are a must for serious traders and investors. You're going to get our Slimulator momentum tracker, over 1,000 symbols. That's for position traders and longer term traders and investors. That is incredible algorithms built in there that gives you the conditions of the market and what our particular bias is on all of these symbols, plus canned groups. You're going to get the SIR daily live stream. That's on the SPX, NASDAQ, and Russell with just unbelievable information in there. The daily snapshot, which is in-depth analysis of the stock market. Matt does phenomenal work on that, and he's going to show you a little bit of that in a few minutes as he does some analysis on the stock market. You'll get the Spider ETF review, which is weekly. You'll get our whole video library. There are about 300 evergreen videos in there, just videos that are in tools for techs or trader psychology or style strategy plan. 10 categories of videos that you will be able to binge watch, and amazing the access that we're giving you to learning for $29.50. And you'll get our workbench where you can organize all of the work that you do and save and track your analysis. Go to askSlim.com, top of the page, click the Learn More button up on the top, and that'll take you to very detailed pictures, graphics of what I just talked about, and you could sign up for $29.50 for the first month. Cancel anytime. You don't have to worry about a renewal if you don't want to, but I have a feeling you will want to. So please do sign up for this special level 2 membership if you are not an askSlim member, or if you're a level free member or 1 member. This is a great way to look at some of the content in the higher levels. All right, stock market analysis. We're going to get into this in depth. Matt has got some great work here. He's going to take a deeper dive into the 2-hour charts, talk about the key levels in there and what the expectations are. I think this is a great way to set up my analysis. So make sure you don't scroll forward, because part of this whole analysis this week is the work that Matt is going to share with you right now. So Matt, show him this great work.
Hello, fellow traders and technical analysis enthusiasts. This is Matt with askSlim. In this brief segment, I'm going to take a look at the current short-term conditions in the S&P 500, which were posted in yesterday's daily snapshot. Before we jump into the analysis, I'm going to give you some quick background information on the daily snapshot. The daily snapshot is published each trading session a few hours after the market closes, and it's included in our premium levels 1 through 4 plus. The primary objective of the daily snapshot is to use the askSlim methodology to establish high probability scenarios based on a combination or some of the evidence using our cycle analysis, momentum analysis, and swing high, swing low techniques at multiple time frames. We're not here to make market predictions because there's no certainty, only odds. All right, so let's go take a look at yesterday's daily snapshot. Do that now. Okay, so yesterday's daily snapshot is right here. What you'll notice is that in each report we have 5 sections, and we provide this information for each one of our indexes. So we have our technical summaries, with which a comprehensive overview of the technical conditions. And then we have our custom charts, our 2-hour, our daily, and our weekly charts. And these are reviewed and uploaded in every report. We also include in the daily snapshot our outlooks on the upside and the downside, and we do that for the short term, the intermediate, and the longer term. We also provide a technical evidence comparison for the indexes so that at a glance our members can see the relative momentum and trend conditions at multiple time frames. And finally, we provide a cycle analysis table which has the details for our daily and weekly chart cycle analysis. All right, so let's zoom in here and take a look at some noteworthy technical highlights that we posted in the daily snapshot for the S&P 500. So yesterday's close below this 39.54 level, along with the reversal scout turning negative, has suggested that the odds have increased for a daily cycle peak occurring on 117.23 at 40.15.39. Now, what levels would be needed to be breached for us to reevaluate that a peak has been established? Well, that's where we are looking at near-term resistance, a zone from about 39.50 to 30.89. Now, if that level is breached at 39.89, that would suggest that a new leg higher is likely underway and a peak has not yet been established. So let's go examine our 2-hour chart for a better visual representation of this technical analysis. All right, so here we have our 2-hour chart. And what we are looking at here is the peak that has likely occurred. And to give us a little bit more context, what I'm going to do is I'm going to overlay our cycle brackets onto the 2-hour chart so we can see all the information that we need here. All right, so in terms of a peak likely been established, what we are looking at here is we have two momentum indicators, a reversal scout, which is this green line that shifted negative on the 17th, and then also we had a close below the slim ribbon, the third band of the slim ribbon. This all occurred within the key short-term resistance zone and also inside of the early to mid-peaking phase. So the typical area where you would see a peak in the daily cycle, all of this price action has occurred, again, increasing the odds that a peak has happened already in the S&P 500. Now, however, because of the magnitude of the prior advance, which essentially retraced nearly 78.6 of this prior decline, along with the fact that there is a good amount of time remaining in this peaking phase here, which stretches out to about, what we're looking at here, to about the end of the month. Because of those factors, the magnitude of this advance, plus the fact that there is still some decent amount of time to go in this peaking phase, we are watching for some upside levels here in the near term, a resistance zone that runs from about 39.50 to 39.89. And if this level was breached at around 39.89, then that would suggest a new leg is underway and a peak has not yet been established. If the SPX fails to resume this upside advance and closes below the short-term 61.8 right here, this would open the door to some additional downside risk, including a revisit or break of the prior daily cycle low, which was over here. So again, if we don't see an advance which pushes through this key near-term resistance zone here in the next week or so, and we first get a close below the 61.8, then the odds have increased that a peak is in place and there is increased risk to the downside where a retest or break of this low, those odds have gone up. So those are the key areas on the upside and the downside that we're looking at. Hope this review of a piece of the analysis from the daily snapshot was of value. Make sure to take advantage of our special level 2 trial offer. We look forward to having you become part of the askSlim community. All right, back to you, Slim.
That's great. Let's get into my analysis now. This is the stock market analysis. I'm going to start this a little bit differently as I'm going to look at the VIX. The reason I'm going to do that is because We believe in doing our analysis based on the core aspects of our analysis, which are cycle analysis, momentum analysis, and swing high, swing low analysis. It's an amazing combination, and as you have seen, gives us a great feel for any market that we look at, and we look at correlations and inverse correlations. VIX, of course, is inversely correlated, and our work had shown that the VIX was likely to be moving down into the late January period, and that's why we thought that the S&P 500 would be moving up into that period. It says SPY here. I'm actually going to look at SPX so that you can see the work that we share with our members, level 3 and level 4, and of course what's included in the daily snapshot that Matt puts out. So let's start out by looking at the VIX. This is a weekly cycle chart on the VIX. I'm just going to blow it out a little bit further. Those vertical lines that you see in there are where the cycles bottomed. The single vertical line tells you where the minor cycle bottomed, and the double vertical line tells you where they nested down over here. And you could see this is where the low nesting was. This is where implied volatilities were declining and the market was stronger. This is where implied volatilities were rising and the market was weaker. So you can see here as the minor cycle rallies that it exploded to the upside as the stock market fell hard back in the end of 2021. Here you could see all of 2022. Here's that half minor cycle low right there. Here's where this one nested here a little bit later. Here is a little bit later also, so there may be a little bit of a right shift going on. And this is the ideal expectation for where this trough comes in. And we had talked about this coming in somewhere around the mid to end of January and potentially leaking into February, where the low in implied volatilities would come. Now, when I look at the daily chart, that tells me that the bottom in implied volatilities is really coming in between these two cycle timing lines that you see right there and right there, and it tells us that it's around somewhere around January 25th to somewhere around February 7th as where the ideal low would be formed, somewhere in that range. And you can see right over here the short-term trough right here where that came, and right here, and these are the ideal cycles that you can see. Beautiful cyclicality here, as this is the reality of how the cycles were formed. This is the ideal cycle right over here, and there is a short-term trough pending right over here. In other words, implied volatilities moving down right in here. Now you see this is the very end of the cycle. Look right over here what happened. You can see a few days where the stock market fell, implied volatilities ticked up, and then there was a capitulation in implied volatility, or a last rally in the S&P 500 or the indexes. That's the same thing as right over here. You see there's a similarity here or here where there's a final move to the downside in implied volatilities. That looks like where we are right now, and that would be a final move to the upside in the stock market before the stock market period of risk comes in. And these higher implied volatilities are due out into February and March. You can see that back here on the weekly, we're projecting, maybe up to 30 out here in this period, and maybe even well up into the 30s and 40s and even higher than that. And then after that, implied volatility should be falling again. So I don't really have this projected perfectly out in time. It would probably be something like this, because we're looking for the bottom to come at the end of March, beginning of April. So that would take you up here, maybe up to 38. This one would be, I'm just bringing this back in time properly. As you can see, maybe getting up to 30 here. But again, we're looking for those peaks to come sometime in the late period period of March, and then what would happen would be this minor cycle would then be pointing down again out here into May. So there would be a steep upward move in implied volatilities to March, and then this decline out into May in implied volatilities, which points to a rally from March, April, May when you look at that. So it's kind of a bigger picture when I'm looking at these implied volatilities. So here is the side by side on that. You could see the weekly, which is getting ready to bottom in implied volatility, the daily, which is getting ready to bottom, and that is suggestive of a peak coming in the stock market. So now let's just go to the daily, and I'm going to switch this over to wait one second. We'll get this over to SPX. There we go. And we're going to look here at these last cycles right there. And you can see the amazing cyclicality. These ovals, these yellow ovals, show you where the period of risk is. And I'm bringing something new in that I shared with our level 4 members just the other day, and that is the minor 1/3 cycle. In other words, this cycle right over here, you could see it's clearly made a low here, here. That's 1/3 of the dominant cycle. That is now lost. It's disappearing, and cycles occasionally go invisible and get taken over by a more dominant cycle. And there's a half cycle right there. So here's the half cycle low right here, and it's beginning to turn up. Here's the half cycle low right over here, and you had that big upward move that failed. You can see that there. And here's the half cycle low right there. So this half cycle is really coming in. So our level 4 members, level 3 members, this is the first time I'm explaining this, I believe. So this is important. So we're in this rally right over here. And this, as we said, the VIX is likely to go down now for at least a few days. This is probably the attempt right over here. You see this evening star that formed there? That is a good indication that the market has peaked at that point. You can see where the market peaked here. That's called an inside down right there. This is an evening star right there. And you note inverted head and shoulders here, and the measurement, it exactly made that right there on that bar and then made it a little bit further. I think that, remember that what we said was that the rally right over here in January, getting up into this level right over here, was a high probability. This following this green line and getting up here to close to 4,100 was a low probability. This is really confirming that to us, that this is a very low probability now, and the highest probability will be a rally up into this area right over here, back into these resistance cell zones, maybe not even making it back up to this level, but it could. That was around 40.14. Right now it's at about 39.31. But when this is over in this next few days, then it's likely to begin moving down again. So this is a short-term analysis, but it's actually taking in this next cycle here. And this is the cycle here that has synchronicity with the March low that we're expecting on the weekly chart. And that means that all of that risk right over there is going to be coming in. And if this fails here below this low and then comes down and gets down to the 78.6, that's 38.15, that will really confirm that this next rally is going to fail and move down sharply. So we're going to learn a lot right now, but this rally that we're seeing right now, or this uptick, that comes at a time when momentum is still strong in here. You see the slim ribbon PO on the bottom. This is about to give you an up arrow, which is an upward momentum resumption. You can see when it did that right over here. And by the way, this is a level 4 proprietary indicator. This gave you a good signal, and it resumed to the upside again when that happened. You can see when this signal came on the downside, it warned you that there was going to be a downside resumption, and that's what happened. So the slim ribbon PO along with the slim ribbon is just a remarkable pair of indicators. Now I want to tell you that the slim ribbon is now available on Tastyworks. So please do let Tom and Tony know that you're excited that it was on there if you use the Tastyworks platform. They'll be glad to hear that, and I'll be glad you told them. So this is a condition which is suggestive that the market will be moving up again into this yellow oval, the period of risk, and then be moving to the downside again. If this falls deeply, it's going to give us a good message. If this remains shallow, it's going to make this upward movement over here have a higher magnitude, and then but nothing I don't think can avoid what's coming out over here into the February and March period, which is likely to give you a sizable downside move. And when I think, as I said in the beginning of the show, investors will be capitulating and probably making the lows for the year for 2023. That's a look at the short-term view. I hope that you didn't scroll forward and miss what Matt told you about the 2-hour charts. I want you to make sure if you did that, you go back and see, because I think that's really was an important part of this analysis. So I want to make sure that you saw that. For those of you that are watching this clip on YouTube, YouTube seems to be having a little bit of a problem because they put out a low definition clip first when we put it up at 480p, and then they upgrade that to 720p. But for some reason last week, some of them didn't get done, and I've heard that they have gotten slow on some of that. So if you're seeing 480p, I really think it is an issue for YouTube, but we're going to keep investigating that. That's the end of what I'm going to show you now. Just want you to please go to our website, click up on the Learn More button on the top, and if you're brand new to askSlim, a great way to learn what we do is to get our 1-month level 2 membership with all of this content for just $29.50. This is the end of this show. Please go to askSlim and get acquainted with things that we put up there on YouTube. Subscribe to our channel. Click that notification bell so that you know we put things up there, and give us a thumbs up, of course. And watch our member videos in the playlists and past shows. On Twitter, follow us at askSlim. And of any questions you have on what I presented, I want you to go to your email and write to Matt at askSlim.com, and he'll be able to give you all of that information. I want you to be so incredibly careful. It is so crazy out there, and I'm always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been